Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I wanted to show you how to actually make money on shares that you already hold by collecting premium through options contracts or getting in on a significantly lower strike price or a price that you want to own the stock at anyway and getting paid to do it. So the example that I'm going to use today is MicroStrategy. So MicroStrategy is essentially a Bitcoin treasury company. They hold about 380,000 Bitcoin at the time of this recording. And the reason I'm using MicroStrategy is because they're extremely volatile. And with volatility, that juices up the premiums on these options contracts significantly. So when most people think about options contracts, they think that you're trying to predict a increase in the future price of a stock, right? You think the stock's going to go up, so I'm going to buy a call, meaning I have the ability to call this contract, call these shares from someone else in the future at a lower price than what it's actually trading for, or a higher price than what it's actually trading for, depending if you're buying calls or puts. So in this situation, we are the casino, we are the house, we are writing the paper, we are selling these options contracts and collecting a premium in doing so. We are not buying the contracts, okay? So let me make this a little bit easier for you to visualize. So this is Robinhood. We're looking at MicroStrategy, ticker symbol MSTR, Mr. And right now, this stock is incredibly volatile. If you look at the volatility for the last week, this thing is all over the place. It's anywhere from $300 all the way to $540 and back down and up and sideways and all over the place, right? So the reason I'm showing you this is because you can make a ton of money, anywhere from like 1 to 10%, even more, depending on how far out you go. But let me break this down. So the reason I'm using Robinhood is because visually, it's a lot easier for me to show you this on Robinhood so you can visualize how this trade actually looks like. So if I go to ticker symbol MSTR, this is MicroStrategy. I'll click on Trade MicroStrategy Options. And right here, what you see in front of you is called an options chain, okay? So on the left-hand column, you have what's called a strike price. Just think of a strike price at which the options contract strikes at, meaning the underlying share price. Right now, it's trading at $380 as we speak, and you can see the different strike prices on the left. Don't worry about break even and percent change, all that stuff. I'm not going to go into like the Greeks, like delta and theta and gamma and all that stuff that's outside the scope of this video. I just want to show you how much you can collect and how to use this strategically. And then I'll also show you the money breakdown using this spreadsheet here as well. So say, for example, you pick an expiring date. So remember, this is just a contract. Think of it like when your auto insurance policy renews or your homeowner's insurance policy renews. It renews at a certain date. So what this time frame is just saying, hey, this contract that I'm writing is going to expire on a certain date. So let's go out 10 days. Let's go to December 6th, right? So if I go to December 6th and I want to sell a covered call, usually what happens is, and this is my real case scenario, I have shares of MicroStrategy. I'm not going to say how much, but if you have at least 100 shares of the underlying security, the underlying stock, you then have the ability to write what's called a covered call. The reason it's called a covered call is because it's covered. You have 100 or increments of 100 shares of the underlying. So if I have 100 shares, I can write one covered call. There's ways to do this without owning the underlying with poor man covered calls, but that's outside the scope of this video. So if I have 100 shares of MicroStrategy, I can write one covered call. If I have 1,000 shares, I can write 10 covered calls. If I have 2,000 shares, I can write 20 covered calls contracts. Every options contracts control 100 shares of the underlying equity, okay? So if I go back to this screen, say, for example, the MicroStrategy is trading at $378 right now, and I wanted to go out into the future to December 6th, and I'm able to sell these different contracts. So say, for example, we're going to use a nice even number of, let's say, $500, okay? So basically what this is saying is that Marco is writing one options contract, and he's selling a call. So he's selling what's 100 shares of the underlying with a $500 strike price, so meaning the shares of MicroStrategy will go to $500, and it expires by December 6th. So there's another person on the other side of this trade. So there's someone buying a December 6th call okay? And they're paying a premium to do so. Who does that premium go to? It goes to you, the writer of the option, okay? The seller of the call contract. So if I click on this right here, you're going to see a price of $11.05. So what does that mean? Am I collecting $11 to do this? No, I'm actually collecting $1,100 to do this. And the reason for that is because, remember, an options contract covers 100 shares of the underlying. So you move the decimal place over 2 places, tens, hundreds. So right now this is worth $1,088. And these change all the time because the price of the stock is changing all the time. So if I were to look at this right here, my expected profit and loss would be whatever the premium is that I'm collecting. In this case, it's changing all the time, but this would be if I sold this for $10.85, I would collect $10.85, right? So if I continue, you can say whatever price you want to sell these at. The bid and the ask spread is basically what the lowest is. This is going to get filled almost instantly. $11.25 may never get filled if it never gets that price. But let's just use $11 just for the sake of this example. So if I were to sell 100 of these shares or one options contract at $11, I'd be collecting $1,999.97. From here, I want to explain what would happen if MicroStrategy actually reaches this price of $500. What I want to show is I want to say, hey, I own 100 shares of MicroStrategy. Depending on a cost basis, meaning how much did I pay to actually acquire these 100 shares of MicroStrategy. Let's say I bought 100 shares when MicroStrategy was trading at $340. That would be $340 times 100. My cost basis in this trade would then be $34,000. Say you got in really early. Say you got in at $150. Say you got in at $100, right? This can change. For this example, I'm just going to use $340 a share. At 100 shares, I own this for $34,000. And this could be all over the place. I'm just using even numbers to make this math really simple so you can visualize this better. So remember, what was our strike price from before? So we're hypothetically going to sell one covered call at a $500 strike price only 10 days away from now. Okay, so in 10 days, if this never meets, say MicroStrategy never reaches $500 a share, nothing happens. Your shares don't get called away. You simply collect the premium, and you can keep doing this over and over and over again. The problem with this strategy is that if MicroStrategy pops to $600, $700, $800, $900 a share, well, then you just capped your upside at $500. You understand? However, if it never reaches $500, you are not under the obligation to get your shares called away. That's why it's called a covered call. Someone is calling those shares away from you. You keep your underlying, and basically you cap your upside. So this is what a lot of hedge funds do. They're long and short at the same time. So if I go back to this spreadsheet, the strike price is $500, okay? The premium collected, what would the premium be if we sold this at $1,100 or $11 a share, right, or a contract times 100? You would receive $1,100. That's the premium we're collecting. It would be $1,099.97, but let's just use 1,100 for even numbers. And what would the strike proceeds be? So if these were to get called away, remember, you'd be selling 100 shares at $500 a piece because it met the strike price by the expiration date. And then the proceeds would obviously be 100 times 500, which would be $50,000. So you can see here two things that I want to break down. Your total profit would be $17,100. And the math is basically this. Your cost basis in the trade is $34,000. It cost you $34,000 to own these 100 shares. You collected premium of $1,100, okay? And the strike proceeds, if the strike price does get met, would be $50,000. So in this case, you would net $17,100 before taxes, right? However, the other thing I wanted to highlight, which is very important, is this. So say, for example, you're a long-term holder of MicroStrategy, and you know you want to keep your shares, but you still have a bunch of shares that you have. Say you have 600, 700, 800 shares, and you write 6, 7, 8 contracts, right, based on those underlying shares. What some people do is they go so far out of the money to where they think, hey, these shares are never going to meet this strike price, and these shares are never going to get called away. So say, for example, I pick $850 expiring December 6th. So do people really think MicroStrategy is going to hit $850 in 10 days? Well, depending on the price of Bitcoin, it very well could, and that's why these premiums are so high, because their stock is all over the place. The volatility is vitality, and the volatility is what's juicing up these premiums on these options contracts. If I were to trade something like VTI or SCHD or something that's very stable, it doesn't move much, like a dividend stock, these premiums are not going to be anywhere near what you see here. So remember, we're making $1,100 in 10 days if it never reaches 500. What some people do is they go so far out of the money, so far out ahead in strike price, if you will, that they think, hey, this is never going to happen until it does. Famous last words. But at that point, you would then just plug in, let's use $850 as the strike price. You would collect $103 in premium. Okay, remember, you just move the decimal place 2 places over, tens, hundreds. So you'd collect $103. So I'd collect $103 in premium if my strike price is $850. My cost basis is the same, but the strike proceeds would be $85,000, which is a total profit of $51,000, okay? But the one thing I wanted to highlight is this. Let's go back to our example of $500, okay? So $500, say they never get called away, okay? So if we go to a strike price of 500, premium collected, let's use 1,100, strike proceeds 50,000. Here's the one thing I wanted to highlight. Your running cost basis actually gets lowered, because think about it. You're into this trade for $34,000. You're collecting $1,100 in premium. That's money today. No matter what, you're collecting that $1,100. Whether your shares get called away or not, this is what you're collecting. Your running cost basis is then lowered by $1,100. So your cost per share went from $340 to $329 just by selling these covered calls. Do you see how powerful that is? So if you want to keep collecting premium, you're going to keep lowering and lowering and lowering your cost basis until that strike price is met, if ever, right? So the cool thing about this is that you can do this on the complete opposite side as well. So what do I mean by this? Not the opposite side by someone else being the buyer of the call. I'm talking about cash secured puts. So say, for example, you have, let's use something that's a little bit below the strike price. So if I use December 6th again, and I want to sell a put, okay? Remember, someone is putting that contract to you. You can then say, hey, I like MicroStrategy, I like the thesis, but I think $379 per share is too expensive right now. I don't want to go in and just buy that amount of MicroStrategy. Say I have $37,950 sitting in my trading account, right? I could choose to buy 100 shares today, right now. I could buy that right now. Or I can use the cash and write a secured put. So a secured put is basically saying, in the last example, we had a covered call where I have 100 shares, and I'm writing the contract because I have the 100 shares as collateral. It's no different than having equity in your home and using a HELOC, right? But for the sake of this example, say I just have the cash, but I don't want to buy MicroStrategy at $379.50, right? What you can do is that money is sitting in your account. You have the cash. You can choose a strike price below what it's trading at today. So say, for example, I really like MicroStrategy at, let's use a nice even number, $315. So within 10 days, if MicroStrategy ever reaches $315, you would then come out how much money out of pocket? It would be $31,500 to buy the underlying 100 shares. Remember, just move the decimal place over twice. 3150, 31,500. Because remember, one options contract controls 100 shares. So if I added this, if I go back, if I take off the 850, you would then see, if I wanted to continue with this cash secured put, I could probably get, let's see, if the bid and the ask is $13.35, the ask is $14.50. Let's just say for even numbers for a spreadsheet, I wanted to collect $1,400. Okay, what I would then do is I wouldn't have any shares, or maybe I do have shares. I just want to get in at a lower strike price, right? Doesn't matter. My cost basis would then be $31,500. The strike price is $315. Premium collected is $1,400. I'm into this trade for $30,100. Because remember, we're paying $31,500 for those 100 shares, but we've also collected $1,400 in premium. So effectively, I own 100 shares of MicroStrategy at $30,100. Does that make sense? So that's why covered calls and cash secured puts, especially on a volatile stock like this, it's very powerful. You're collecting a lot of premium. However, when something is as crazy as MicroStrategy, there's a reason why the premiums are so high. Say, for example, this executes at 315, and then MicroStrategy drops to 265, right? So even though my running cost basis is $301 per share, remember 30,100 divided by 100, MicroStrategy is now trading at 265. So I'm still in the hole, right? So the beauty of this is that you can do this any other way. It's just another tool in your toolbox. So what I'm actually doing is I'm writing covered calls on my 100 shares. And I'll show you a real trade that I did. So this is an actual covered call that I wrote against my MicroStrategy shares. So I wrote one contract for December 20th, 2024 with an $890 strike price. Remember, $890 per share, and it was a covered call. So what I collected in premium just by doing so was $3,249, and this was for less than 30 days. Okay, remember, I did this on the 22nd with a December 20th expiration date. So in less than 30 days, I collected $3,250 just by holding these shares, right? So that's why this is just another tool in your toolbox. However, I wouldn't do something like this unless you're really bullish on the stock and you don't mind owning 100 shares of it and coming out of pocket whatever that strike price is times 100. So hopefully this was helpful for you. I don't trade options often, but if I have something that's super volatile and I have a lot of shares of it, why not get paid? So if I actually I can show you a real life scenario. I don't want to show you my cost basis, but what I'll use is I'll use this actual example here. So this was a December 20th. Let's say I have 100 shares of the underlying. Let's use that same cost basis of $340 per share. Okay, my cost basis is lower. Strike price was $890. The premium I collected was $3,250, and the strike proceed, if that ever did hit in December, I'd collect $89,000. So my running cost basis for this example would be $30,750, $307 per share, and my total profit would be $58,250. So again, this is just another tool in your toolbox. I wouldn't recommend doing cash secured puts on MicroStrategy unless you're a very long-term bullish believer, because then you're buying 100 shares of the underlying. But also, this thing can run like crazy. So if mine were called away at $890 and it goes to $1,200, I'd be kicking myself in the butt, right? But these premiums are so juicy right now that do I mind making $58,250, right, by holding this trade for 20-something days? I don't. I've held MicroStrategy for months now, almost a year, but I've known about it for 4 years. Hindsight is 20/20. It is what it is. But I just buy Bitcoin. So anyway, this is just an example. You can do this for any stock that has options trading available for it. It's a good way to get into something that, like an S&P 500 fund, that you don't want to pay the exact strike price at today. Say you have 1,000 shares of SPY, you can do this for SPY. You can do this for a bunch of different underlying assets that have options trading available. Hopefully this was helpful. Send this to a friend or a family member. Hit the subscribe button, and as always, have a prosperous day.